Good evening, and welcome to the Crypto Overnighter. I'm Nicodemus, and I will be your host as we take a look at the latest cryptocurrency news and analysis. So sit back, relax, and let's get started. And remember, none of this is financial advice. And it's 10 p.m. on a Tuesday, May 9th, 2023. Cryptocurrency exchange Bittrex has filed for Chapter 11 bankruptcy protection in the District of Delaware. The bankruptcy filing covers Bittrex, two Bittrex entities in Malta, and an affiliated entity, Desolation Holdings LLC. Bittrex Global, the Liechtenstein-based global entity for the exchange, was not included in the filing. The bankruptcy filing comes after the U.S. SEC charged Bittrex and its co-founder and former CEO, William Shahara, with securities violations in April. The SEC claimed Bittrex and Bittrex Global operated an unregistered securities exchange. In October, the exchange also received charges concerning Bank Secrecy Act violations from the U.S. Treasury's Office of Foreign Assets Control. They agreed to pay around $29 million in their settlement. OFAC is the largest creditor listed on Bittrex's bankruptcy filing, with the exchange booking a $24.2 million claim for the office. Its next largest creditor is a crypto wallet with a $14.5 million claim. FinCEN is also listed as a top 50 creditor with a claim of $3.5 million. The SEC is listed with an undetermined amount of claims. The SEC's enforcement actions and its recent bankruptcy filing comes as Bittrex announced in March that it would wind down its operations in the United States by April 30th, citing continued regulatory uncertainty in the country. It has been a challenging year for Bittrex's entity in the United States in 2023. The exchange also cut 83 employees in February, citing the crypto market downturn caused by the collapses and bankruptcy of other crypto firms. Bittrex's bankruptcy is the latest in the crypto exchange or lending platforms that have also recently filed for Chapter 11 protection, including FTX, BlockFi, Celsius, and Voyager Digital. And going from exchange to exchange, let's talk about Coinbase. Because their legal chief has requested the SEC make several revisions to their proposed regulation, especially on the responsibilities of registered investment advisors for storing client assets with qualified custodians. Although the SEC acknowledges Coinbase Custody Trust Company as a qualified custodian, Coinbase contends that the updated custody rule unfairly targets crypto. Not at all a surprise from Gensler's SEC. It also says that it makes improper assumptions about custodial practices based on securities. Coinbase Chief Legal Officer Paul Grewal wrote in a May 8th letter that the proposed SEC rulemaking fails to safeguard other asset classes, including cryptocurrencies. As I said, the Coinbase Custody Trust Company is recognized as a qualified custodian for RIA clients. They're recognized for protecting their client assets from potential threats such as bankruptcy and cyber attacks. This letter advocates for expanding the custody obligations proposal to ensure that it remains adaptable to future investments and protects them appropriately. An RIA is a company that advises clients on investments in securities. It may also handle their investment portfolios. These firms are registered with the SEC or state securities administrators, depending on the value of the assets under management. Now, Grewal sent a letter to the SEC. This letter criticized the proposed rulemaking titled Safeguarding Advisory Client Assets Proposed Rule 223-1 as misguided. Grewal called for a revision to proposal and staff guidance. He called out the need to safeguard all asset classes, including crypto assets, which haven't been classified as securities until now. Grewal suggests several revisions to the rule to protect investors. One such suggestion is defining state trust companies and other state-regulated financial institutions as qualified custodians, a long-standing congressional and SEC policy. He also proposes allowing limited exposure to non-qualified custodians and removing the ban on RIA client trades on crypto exchanges, which are not qualified custodians. Coinbase filed a lawsuit in April 22. That lawsuit requests that the court compel the SEC to publicly disclose its stance on a petition submitted several months prior. In the petition, the exchange posed 50 specific questions about the regulatory treatment of certain digital assets. The SEC is expected to comply with the court order and respond to Coinbase this week. And that brings us to our cover story for tonight. The Financial Services and Markets Authority of Belgium said in a statement on Monday that it had previously notified Bit4U of its intention to refuse its registration request. The regulator said that it had informed the public prosecutor of irregularities noted regarding the former management of Bit4U. Now, Bit4U said that it was suspending activities in April. They cited the collapse of their service provider, CoinLoan, which held many of their funds. However, the FSMA's revelations suggest that there may be more to the story. Due to its filings, the FSMA said that Bit4U had been forced to modify all of its governance structures. The regulator also said it had opened a file on Bit4U following the accusation by FSMA, adding that an investigation is still ongoing. It is still too early to say what the long-term impact of this news will be on the crypto market in Belgium. However, the FSMA is clearly taking a tough stance on crypto exchanges. This could make it more difficult for new exchanges to enter the market and lead to increased scrutiny of existing exchanges. It's important to note that Bit4U is one of many crypto exchanges operating in Belgium. The FSA has not taken any action against other exchanges. This case will probably be an isolated incident. However, it is possible that the FSMA is planning to crack down on all of the crypto industry much more broadly. And from Belgium, let's turn our attention to Canada, which is the source of our CBDC alert for tonight. The Bank of Canada has asked Canadians for their input on a potential digital dollar. The consultation, which runs until June 19th, is part of the bank's exploration of a virtual loonie as the world becomes increasingly digital. The bank says that it's not starting to work on a central bank digital currency just yet, and it's not looking to replace cash. But it says that it wants to hear what Canadians value most in the design of a digital dollar to help it make choices related to its security and reliability. The consultation's questionnaire asks Canadians a wide range of questions, including the payment methods they've used in the last month, how often they would potentially use a Canadian CBDC, and what the design features they wish to see are. It also explicitly asks if the survey taker uses or holds cryptocurrencies. The bank says that it will publish a report summarizing the consultation later this year. The Bank of Canada's consultation on a digital Canadian dollar indicates the central bank is taking the idea seriously. This could affect the markets, increasing the demand for cryptocurrencies and other digital assets. That's what happened in Nigeria. They're trying to force everyone onto their central bank digital currency. Less than 0.5% of their population is even interested in using a CBDC at all. But cryptocurrency is on the rise in Nigeria, specifically I think because of the CBDC, and I expect the same thing would happen in Canada as well. A Goldman Sachs report published on May 8th titled Eyes on the Horizon, Family Office Investment Insights found that 32% of family offices currently hold investments in digital assets. This category includes cryptocurrencies, NFTs, DeFi, and blockchain-focused funds. Explaining their motivations for investing in digital assets, most, 19%, cited a belief in the power of blockchain technology, with only 8% and 9% citing speculation and portfolio diversification, respectively. The proportion of investments in cryptocurrencies among investors interested in digital finance has risen significantly since 2021, from 16 to 26%. However, the interest in potential investments in crypto has crashed this year, with just 12% of investors indicating it, down from 45% in 2021. Quote, opinions on cryptocurrencies seem to have crystallized. A greater proportion of family offices are now invested in cryptocurrencies, but the proportion that are not invested and are not interested in investing in the future has grown even more. The report is based on a survey conducted between January and February of this year. Questionnaires were sent to home offices by email. Overall, 166 home offices participated, so not a huge number. 95 based in the Americas, 34 in Europe and the Middle East, and 37 in the Asia-Pacific region. The decline in interest in cryptocurrency investments among family offices is also worth noting. This could be a sign that the market is maturing and that investors are becoming more discerning about where they put their money. Overall, the developments in the digital currency space are worth watching closely. They could significantly impact the markets in the years to come. Bankrupt Bitcoin mining firm Core Scientific is objecting to a $4.7 million claim put forward by crypto lender Celsius Network. This dispute is the latest in a long-running battle between the two firms over contractual obligations. Core Scientific signed a contract with Celsius in 2020 to host its cryptocurrency holdings in Core's data centers. However, due to an increase in the price of power, Core passed these additional costs on to Celsius. Celsius initially paid these costs, but ceased payments after filing for bankruptcy. Core Scientific now argues that Celsius owes it approximately $11 million, including fees and interest. The Bitcoin mining firm is also accusing Celsius of, quote, blatant post-partition violation of the agreed-upon dispute resolution mechanism. And as we head into our last story of the night, I'm going to ask you to like, follow, and subscribe to the podcast. It really makes such a big difference when trying to attract new eyes to the show. So thank you for that. And now the latest update on the FTX founder, Sam Bankman-Fried. Late Monday, Bankman-Fried filed pre-trial motions to dismiss most charges against him, as you do. Bankman-Fried is set to go on trial this fall, facing over a dozen charges ranging from wire and securities and commodities fraud allegations to bribery claims. These charges were brought across multiple superseding indictments tied to his conduct as the former chief executive officer of the Bahamas-based crypto exchange FTX. That exchange collapsed dramatically last November, filing for bankruptcy alongside nearly 100 related firms and subsidiaries. Bankman-Fried's attorneys filed several motions seeking to dismiss charges, including conspiracy to commit wire fraud on FTX customers and wire fraud on Alameda research lenders. They also moved to dismiss the bank fraud conspiracy, unlicensed money transmitter operation, unlawful political contribution, and bribery charges on discovery grounds. Bankman-Fried's attorneys did not seek to dismiss charges alleging conspiracy to commit securities fraud, and conspiracy to commit money laundering. Now, part of their argument is this. Under the terms of the extradition treaty between the Bahamas and the U.S., the Bahamas needs to consent to the charges brought after the extradition. And the Bahamas, where Sam resided at the time of his arrest, could not consent without additional information that has not been provided. And that's going to do it for us tonight. I want to thank you, my listeners, because when you stop listening, I will stop talking. If you enjoyed tonight's show, then please like, follow, subscribe, leave a rating, or maybe a review. And in the meantime, we'll see you tomorrow night.